All right. Welcome back to the Edge-Forex podcast. This is George, and today we're diving into something that gets the market all riled up. Short selling. Some love it, some absolutely despise it, and yet everyone's got an opinion. So what's the deal with short selling? Is it an ethical trading strategy that keeps the markets in check? Or is it like rooting for your team to lose just so you can cash in on the bets? Stay tuned, we're going to peel back the layers on this one, and I promise it's not as black and white as you might think. Let's get into it. Okay, so before we get too deep into the ethics, let's make sure we're all on the same page about what short selling actually is. And if you've been in the trading game long enough, you know this, but for the newbies out there, quick rundown. Here's how it works. You borrow a stock from someone, sell it at the current price, and then wait for the price to drop. When it does, you buy the stock back at the lower price, return it, and keep the difference. Simple, right? Now, the reason it gets shady in some people's eyes is because, well, you're basically betting that these stocks going to tank. You're making money off a company's failure, or at the very least its temporary struggle. So the big question is that ethical? We'll get to that in a minute. Here's where things get juicy. Is it right to profit from someone else's downfall? I mean, think about it. You're betting against a company, possibly adding to the fear that drives its stock price down even further. Some folks say that's like kicking a guy when he's down. Not cool, right? But here's the other side of the coin, and it's a big one. Short sellers can actually serve a purpose. They expose companies that are overvalued, running on hype, or in some cases, engaging in straight-up shady business. Think about Enron. It was short sellers who first spotted the cracks in the facade. They can be the watchdogs that prevent bubbles from growing out of control and bursting. So, are short sellers the villains here? Or are they more like the market's anti-heroes, stepping in when everyone else is turning a blind eye? Now let's talk about the big one, stability. The question on everyone's mind, does short selling help keep the market stable, or does it send it into chaos? Look, I won't sugarcoat it. When things go south, short sellers can make it worse. If a company's stock is already sliding, heavy short selling can send it into a free fall. And that can trigger panic selling, where everyone rushes to dump their shares, driving the price down even more. Cue market chaos. Remember the whole GameStop situation? Yeah, short sellers were caught in the middle of that storm. And this is a big but, short selling also helps with something called price discovery. In other words, it helps bring stock prices in line with reality. If a stock is overvalued, short sellers help bring it back down to a reasonable level, preventing bubbles from forming. And we all know what happens when bubbles pop. Looking at you, 2008, more liquidity, better price discovery, that's the argument for short selling. But can we ignore the downside? When emotions are high and fears in the air, short selling can make a bad situation even worse. And because of this volatility, short selling isn't exactly the Wild West. There are rules. Regulators have stepped in to try and keep short sellers in check. After the 2008 financial crisis, for example, short selling was banned on financial stocks to stop them from spiraling into the abyss. In Europe, similar restrictions were put in place during the debt crisis of 2010 and 2011. But here's the kicker. Do these regulations actually help the market? Or are they just band-aids over bigger issues? Some people argue that these short-selling bans don't solve the root problems. In fact, they might even create artificial price floors that make the market even shakier in the long run. It's like putting a lid on a boiling pot. The pressure's still there, waiting to explode. So, are these bans doing more harm than good? I'd say it's a mixed bag. They can stop the bleeding temporarily, but if the market's fundamentally broken, they're not going to fix it. Now let's talk about the companies themselves. Short selling can have a huge impact. If a company's already struggling, a big short interest can scare investors, make it harder to raise money, and sometimes push them over the edge. Not a great look, especially if you've got employees and stakeholders relying on you. But again, flip side, if a company's riding high on hype but doesn't have the fundamentals to back it up, short sellers can force management to take a good hard look in the mirror. Maybe they need to cut costs, refocus, or even expose some fraud. It's not a fun process, but in the long run, it could save the company, or at least prevent more damage. So what's the verdict? Is short selling the villain of the stock market, or a necessary evil that keeps things in check? Honestly, it's neither black nor white. Like most things in finance, it falls into that grey area. It's a tool, and like any tool, it can be used responsibly or abused. Short selling can enhance market stability by bringing prices back to reality, but it can also trigger panic and make downturns even worse. Its ethical standing? That depends on who's doing the short selling and why. At the end of the day, markets need checks and balances. Whether short sellers are the heroes or the villains of that story, well, that's up for debate. That's it for today's episode. If you've got thoughts on short selling, and trust me, I know you do, drop a comment on our Discord or hit me up on Twitter. Until next time, trade smart, stay sharp, and keep pushing the edge. Later, folks.